Well, good morning, everyone, and welcome to the Women in Business Credit Study webinar. Before we begin, I would like to remind you to use the question and answer box located in your WebEx toolbar. We will be leaving a little bit of time at the end of today's session for some questions. If you'd like to download the slides for today's program, we've placed a link that appears in the lower left of every slide of the deck. So feel free to download those beforehand. We'll also include a link to a recording and a copy of the slides after the program concludes. And during today's webinar, we're going to be discussing key findings in research Experian is conducted on women business owners and women-owned business. Our speaker today is Andrew Moore of Experian Commercial Data Sciences. Andrew is an analytical consultant within the Commercial Data Sciences team here at Experian. He provides strategic analytical support across all business verticals. And in his role, Andrew supports custom engagements for commercial acquisition models and credit risk mitigation, commercial underwriting, commercial marketing. Andrew also provides key support for all initiatives and opportunities surrounding the Small Business Financial Exchange Data Consortium and participates in internal research and analytics. Prior to joining Experian, Andrew worked as a senior consultant for Equifax for 6 years, supporting clients in the telco, utility, and pay TV verticals. He has an extensive experience in the automotive credit reseller markets as well as the consumer payments industry, and has an MBA from Louisiana Tech University. And so I'd like to hand things over to Andrew for today's program. Welcome, Andrew.
Thank you, Gary. And thanks everyone on the phone for joining. Today we're going to be talking about women in business. I think we have a very good study to share with you today. And so I hope you enjoy the content that we've prepared. So let me begin the presentation by providing a data overview and provide some context as it relates to what we were looking to evaluate and how we went about evaluating the study and sourcing our findings. So we created a sample, we sourced a sample of 3.1 million total records from June 2016 to June 2018 from our CRDB credit risk database, commercial database. And we wanted to look at those consumers, or those commercial entities where we could assign a male or female business owner identifier. So we looked at 2.8 million of those entities that had that associated identifier. And in the totality of what we pulled, we assessed a wide swath of data. Not everything that we assessed made it into this study, but we looked at a wide breadth of data and analytics and insights. Some of those attributes that we assessed were trade counts and trade balances, financial credit inquiries, trade types, performance associated with those trade types or trade lines, firmographic information such as income and sales. And the goal of this analysis was to compare how male and female-owned businesses operate from a credit perspective, and then compare and contrast what do we see from a credit profile standing, from the utilization of credit, who's utilizing commercial credit, who isn't utilizing commercial credit, and then based on those findings, what do we see as the ultimate impact? Jumping the gun a little bit, what we see is we do see a material impact in the difference between how male business owners and female business owners fund their businesses, and ultimately we see a difference in how both those owners' commercial and consumer credit profiles are impacted. So that's going to be the storyline, and we're going to work to build that out. So before we start, I'm going to provide this quote. I found this quote very interesting for a number of reasons, so I'll walk you through it. So this is a quote from Brookings regarding women-owned businesses and economic empowerment. And one of the pieces of it, it states that in order to overcome obstacles facing women entrepreneurs, we need to move beyond basic access to financial and human capital. So the way I interpret that is everyone should, in a free market economy, everyone, both male and female business owners, should have equitable access to employees and equitable access to funds, to capital for funding their business. And one of the interesting things, so if you move further through the quote, one of the interesting things that's referenced is psychological constraints. and see that we need to move beyond, we need to overcome these psychological constraints. And I find that interesting because as we see there's a real difference in accessing capital. And we'll view it in the present, and we'll view it from a trended standpoint as well. But there seems to be, as the study will suggest, there seems to be this psychological barrier from female business owners in accessing capital or understanding how to go about accessing capital, or a level of comfort with accessing capital. But we do see that there's this big disparity between male versus female business owners in accessing it, and it appears to be this psychological barrier as it relates to running or managing or funding a business, and how they go about accessing funds. So to start, let me give you an overview of women in business today. And so women in business are capitalizing on the economy by opening businesses at a record pace. And so according to a 2018 study by the Women's Business Enterprise National Council, in 2018, on average, 1,821 net new women-owned businesses were opened every day. So in terms of economic expansion and women's impact to the economy and capitalizing on the economy and starting businesses and pursuing entrepreneurial pursuits, women are doing very well. So that was very good from just a growth and sheer market penetration standpoint. You can see some of the industries, so I'll touch on this briefly. One of the things in the study, we want to focus on these industries where women are more congregated, so personal businesses, or I'm sorry, business services, personal services, engineering, accounting, retail, real estate, health services. So we're going to focus on those, but we're also going to look in the aggregate as well, so look at all industries. And one of the things that we're going to find is that there are significant differences, again, in how these businesses operate by vertical, in terms of industries as a whole, as well as the overlap population, meaning we'll look at where we have comparable percentages of the total population of male business owners and female business owners operating in similar industries. So next we're going to move to, I want to focus on, the next 3 slides we're going to focus on more of a firmographic view. So one of the things we wanted to do is look at businesses overall from a firmographic perspective. So, you know, sales, employees, so on and so forth, and see, is there a material difference in the types of businesses that men versus women are opening? And would that suggest a difference in the need for credit? Is there some material difference between the types of businesses that would suggest more or less funding is needed by one group versus the other, and help explain some of the differences that we're seeing in their credit profiles? So first, at the highest level, we wanted to look at home-based businesses. So I guess one of the initial thoughts we had was, do we see males, do we see males having more storefront businesses or, more freestanding entities as opposed to women having more home-based operations, which, in and of itself would suggest more or less need for capital. And we found that there's not a material difference. So everywhere that we could identify a home-based business identifier, we found that, there's parity in terms of, or there's no material difference in terms of home-based business versus freestanding businesses. So again, it's not like men have, X percentage more freestanding businesses, which would require some, additional level of commercial funding. So really, from a parity standpoint, men and women, in terms of the types of businesses they operate, i.e., home-based or freestanding, they were very comparable. So we didn't see a material difference in this. But again, we see that the financial management of these types of businesses varies significantly. So next, I want to spend some time on this. So I'm going to talk about, on this slide, I'm going to talk about employee size, and on the next slide, I'm going to talk about revenue. This is going to denote women-owned businesses. The next one's male, so I'm going to use these interchangeably. So again, we saw that the types of businesses are similar as it relates to home-based versus freestanding. But also we see a lot of similarities in terms of employee size and revenue. So both genders tend to own businesses of similar size, with 63% of women own businesses reporting between 1 to 4 employees, while 62% of male-owned businesses report the same. And then furthermore, 21% of both gender businesses report having 5 to 9 employees. So in terms of business size relative to employees, again, no material difference, or nothing that stands out as some, identifying factor that would relate to a reason as to why there is a material difference in business owners' credit profiles. And the last firmographic item I want to touch on is revenue. So men are more likely than women to have businesses that have higher revenue, even with the same number of employees. Again, very comparable in terms of number of employees and 1 to 4 in the 5 to 9 bucket. But we found that 58% of women-owned businesses had yearly revenue of less than $500,000 compared to 51% of male-owned. And then we see the same revenue differences in the upper ranges, with about 23% of male-owned businesses reporting revenues of between $1 and $4.9 million, while about 19% of female-owned. And one of the things that I was thinking about, and we'll look at in a moment, is, some of the industries, if you think from an industry perspective, such as construction, a very high-ticket item, if you will, or cash-intensive, capital-intensive industry, where I think about 10% of the male-owned businesses we identified fell within a construction SIC code. If you think about that, that could skew, not skew, but that could elevate numbers from a revenue standpoint, these male-dominated businesses versus female-dominated businesses. So that could explain, some of the differences. But I did want to say that, in the aggregate, and looking at this in terms of employee size and in terms of sales volume and in terms of types of businesses, they're very comparable. Again, there's no identifying factor or something that, a flashing beacon that says this is the reason why males versus females would have a differing credit profile or a different need for, or materially different need for funding. So again, everything is comparable from a firmographic standpoint. So having seen this, we wanted to delve into the actual data. So start looking at trade lines, start looking at debt loads. What do we see from a credit profile standpoint to further delve into the differences in access to capital funding or to commercial funding? So I want to take a moment and talk about this slide. So when we started the analysis, we were looking, we wanted to identify other points of reference. So here we have this was a poll taken from score.org, and SCORE is the nation's largest network of volunteer business mentors. More than 10,000 volunteers are part of this, and I think they have over 300 chapters. And the question to female business owners was, did you seek financing for your business? And so in the pie chart, you see 27% of respondents said yes, while 73% of female business owners said no, they did not seek it. So we found that very interesting. In conjunction with this study, Experian interviewed a number of Experian on our own interviewed a number of female business owners and asked the same question. We wanted to delve into, does this align with what we're seeing, and then what are the reasons behind it? So for the respondents that said yes, the reason they sought funding was in line with expectations. Yes, I've begun taking small loans to build business credit. I want to expand and grow faster than the current organic rate. Obviously, you need funding for accounts payable, receivables, inventory, marketing, working capital, going beyond just your sales revenue and profit margins. On the other hand, again, for the respondents that said no, we asked the question, so I'm currently self-financing. And this is the one I found interesting, and it goes back to that psychological barrier that we talked about at the onset. No, because I did not think I could find financing. So again, even from an interview standpoint, just asking respondents or asking business owners why did they not do it, you continue to see this psychological barrier aspect or notion prevail. I did not think I could find financing. So there seems to be this inherent, I don't want to say lack of knowledge, but this inherent barrier to women-owned businesses and their perception or their perceived ability to be able to capture or capitalize on commercial funding, again, when in a free market, or everyone should have same access to the same capital. So again, this theme continues to emerge. So moving on. So again, that was from a third party. And so for the purposes of our analysis, we wanted to look and compare and contrast our data with what we saw or what we had seen from the third party's the third party's question. So we went and looked at business owners seeking credit. So if you look at the pie chart on the right, of the sample that we had, of the 2 million plus that we had, male business owners accounted for 78% of active credit shoppers, while 22% of female business owners accounted for active credit shoppers in the last 3 months. So from a sanity check standpoint, this aligned very well with what we saw previously. Again, it was 27% of female respondents that said that they had sought credit. Here we see 22% of active credit shoppers in the last 3 months were female. So again, from a checks and balances and from a sanity check standpoint, I felt really good about this number, and I found it very interesting, that we quantified a poll with our actual trade line inquiry data. And if you look on the left-hand side, so the attribute that we analyzed were total inquiries in the last 3 months for financial credit. So who in the current market or in the immediate time period is seeking credit? And you can see that men on the right-hand side seek credit much more frequently and for more money than female business owners. And then so we see that in the immediate, but one of the things that was of most interest, and I want to say most concerning, but I guess it is concerning to some extent, was the trend. So not only did we see this occurrence in 2018, so a very recent time period, but this goes back as far as our study to 2016. So again, the psychological barrier is not something that's new. This has been going on at least since 2016, and it seems to be a continual trend that I'm sure continues past 2016. But there's this inherent trend in the marketplace whereby male business owners more actively seek credit, more actively shop for credit, commercial credit, rely more heavily on commercial credit funding to fund their businesses. And this has a material impact, as we're about to see, on female business owners, I'm sorry, the lack of shopping for commercial credit has a material impact on female business owners. But I found that very interesting, that this is not just an immediate here and now issue or immediate or here and now concern. This has been a continual trend for a period of time. And again, I'm sure this goes back a number of years beyond 2016. So how are owners financing their businesses? Or what do we see in terms of variances in commercial credit between men and women? So when we actually start looking at trade counts and the amount of commercial debt or outstanding balances, we start to see a very, very different picture between the two parties. So on average, so looking at the right-hand side, on average, female business owners have less than one trade line. So they average about 0.6 trades in terms of commercial credit or commercial trade lines, whereas male business owners average about 1.4 commercial trade lines. What's even more telling than that, I think more impactful than that, is when you look at the balances. So men in general carry about $40,000, just over $40,000 in commercial credit, while women business owners carry about $25,000. So there's about a $15,000 variance in outstanding commercial debt between male-owned businesses and female-owned businesses. And if you think about it, that's huge from a competitive standpoint. So, if you have two businesses standing side by side, and one business has $40,000 in funding, and the male business has $40,000 in funding, and a female-owned business has $25,000 in funding, that is material. That variance, that $15,000 is a material, as a percentage, and even more so when you start thinking of competition and your ability to market, your ability to carry inventory, your ability to fund your business, working capital, all of the things that you need to run and manage a successful business. That disparity is significant when you think in terms of, men versus women doing business in comparable industries. So that was a very telling insight into just how big the disparity is between the utilization of commercial credit between men and women to fund and run their businesses. So, as I mentioned early on, we know that female business owners are thriving. They're opening a lot of businesses, 1,821 on average per day, thriving in these economic times. And so the businesses are successful. So we're not talking about, some huge default rate or women-owned businesses going out of business. So somehow they're funding these businesses. They're funding their operations. They're maintaining some level of success in the market. So how are they financing it? So we wanted to take a deeper look in terms of credit profiles. So on the left-hand side, again, if we look at total commercial trades, we see that, I apologize, on the left-hand side should be female and the right should be men in the chart on the left. Those identifiers didn't make it to this. But you see that men have, or females have about 15.69%, or 15.69% of female-owned businesses have 6+ commercial trades, whereas 24.99% of men do. And those middle charts, or the middle graphs in purple, which represent 1 to 5, I'm sure if that was more granular, you would see that a much higher percentage of men have 2+ when compared to female business owners. But on the right-hand side, we see this paradigm shift. This is where when we started looking at number of consumer trades, we see a material shift in outstanding consumer trades between men and women business owners. So 28.29% of female business owners have 10+ consumer trades, whereas only 20.19% of men. Furthermore, if you look at 20+ trades, you see about 5% compared to 2.5%. So again, when we look at the difference between commercial trades versus consumer trades, we begin to see this very interesting and material shift between the amount of trade lines. Men have much more commercial trade lines. Women or female business owners tend to have significantly more consumer trade lines. So this is where we start to see these characteristics of self-financing begin to emerge. And so having seen that, we wanted to take a deeper dive on what are we seeing, what's the impact, and let's go look at debt load and see what's occurring here to substantiate this theory or this hypothesis that female business owners are utilizing consumer credit to self-finance. So as I mentioned earlier, excuse me, first we wanted to look at all industries. So how are owners financing their small businesses across all industries? So we're going to look at the aggregate. And again, we know that some industries are much more male dominant than others. Again, using construction, for example, a very high percentage of the observations in our data set, I think about 10%, had an SIC code akin to construction management, that general field. So we know that's a high-ticket, capital-intensive market or industry. So we know there's going to be some skewedness, but we wanted to take an aggregated look at everybody, and then on the next slide we'll break it down a little bit further. So here we're looking at overall numbers. Again, on the left-hand side we see that men have more commercial and more commercial trades than women, less consumer trades than women. So all of that maintain. Where it becomes interesting is what we start seeing when we look at the average debt load. So on the right-hand side, male business owners on average carried about $42,000 in average debt. Now again, this is excluding mortgages. So everything excluding mortgage, about $42,000 in commercial debt versus $36,000 in consumer debt. So we saw about a 12% increase from commercial to consumer debt. But for female business owners, we see a materially different shift in that. We see an increase of about 23% commercial to consumer, which is material when you think about the amount of consumer debt, the consumer debt load. And again, you're going to see how this trickles through to their credit profile, both on the commercial and the consumer side. But again, this large uptick in terms of consumer balances further substantiates this notion that female business owners are much more reliant on self-financing as opposed to accessing commercial credit. Again, this is a psychological barrier. What is driving this behavior to self-finance, to rely on consumer utilization of credit to fund businesses? So we see this complete shift in debt load between male business owners and female business owners. So having noticed that and looking at all industries, we wanted to further isolate or further examine what are we seeing on the industries that I mentioned at the onset, whereby we have parity or overlap between male business owners and female business owners. So on the right-hand side, I isolated the top 5 industries. Looking at an overlap population. So I wanted to say, for real estate, about 5% of male-owned businesses operated in the real estate SIC code, and a comparable percentage of female-owned businesses were in that SIC code. So, line it up 5% of the total population to 5% of the total population. So we wanted to look at industries where there was parity in terms of percent of total population business types. So again, on the left-hand side, the average number of trades remain the same. So we don't see any shift in terms of, or any variations in terms of commercial versus consumer trades. The difference, while the number of trades will vary, the difference, i.e. men having more commercial and female having more consumer, remains the same. However, and I think this was a real aha moment. If we look on the right-hand side, first we notice that for male business owners, we do see about a 10% increase in consumer debt. Now, again, this could be a product of the types of industries. So if we're looking at the industries in question, business services, that's easy to be, run out of your home, or that could be something that is easily self-financed. Real estate, if you're an independent real estate agent or something like that. So we do see an increase in consumer by about 10%. Is that material? I don't know based on the study. I would tend to think not. I would tend to think that it's more of a product of the industries. Regardless of that, or on the converse of that, when we look at female-owned businesses, we see a 73% increase in consumer debt balances. I found that to be extremely material as it relates to this study, and an extremely supporting, or a very supportive point of the notion that female business owners tend to self-finance. They do not rely on commercial credit to the extent that male business owners rely, and they are carrying extremely high debt loads to self-fund their female-owned businesses. But again, 73% increase. So when we look at the overlap population, so men versus women in comparable industries where we have representative samples or percentages of both, we see women denote a 73% increase in the amount of consumer debt that they carry over commercial. So again, the size of this variance supports the notion that female business owners are very reliant on self-financing. And again, is that this psychological barrier? I would tend to think yes, and again, it supports that trend that we saw over the past 3 years that there's an inherent lack of pursuance for commercial credit by female business owners to fund their businesses. So what does this mean? So this is well and good, but what does it mean? And to answer that, we wanted to take a deeper dive, and go look at what's the impact if you're carrying that much debt. If you're not using commercial credit and you're using your own consumer credit, you're using revolving lines of credit, or you're using credit cards, what is the impact that it has on female business owners? Because it has to have some downstream impact to credit scores or credit profiles. So we wanted to evaluate or see, do these trends or do these findings as it relates to credit balances and the utilization or lack thereof of commercial credit, does that impact, what is the impact to the ultimate consumer or guarantor for that of the business, the business owner? So next we looked at a credit profile comparison. So at the highest level, so using Vantage Score 3.0, we looked at the credit scores of consumers across all industries. And we wanted to see, do these finance characteristics, does, utilizing commercial or consumer credit, the amount of utilization, does that play out in your credit scores and or credit profile? So looking at this in the aggregate, again, across all industries, male business owners tend to have a higher credit score, a higher percentage of male business owners tend to have prime or super prime credit scores, 51% of male versus 46% of female business owners. On the converse, a higher percentage of female business owners tend to have subprime or near prime credit when compared to males. So what it suggests here is that men have stronger consumer credit, they have broader commercial credit, and one of the things I started thinking about, and it makes sense, this variance, when you take into account the component pieces of credit, so if I take into account the component pieces of a credit score, what makes up a credit score? Inquiries, trade lines, utilization rates, so on and so forth, it makes sense that, or I would surmise that female business owners, if you're carrying extremely high consumer credit balances, extremely high utilization rates on revolving lines or credit cards, a lot of inquiries on consumer credit, a lot of trade lines on consumer credit, it makes sense that those characteristics of self-financing, those characteristics of heavy utilization of consumer credit would put downward pressure on your consumer credit scores. So all of these characteristics point to, all of these characteristics, or all the characteristics of self-financing, point or offer support to suppressed credit scores for female business owners on their suppressed consumer credit scores. So that was an interesting notion. So it's my contention that their actions in terms of utilizing heavy consumer debt financing is suppressing their consumer credit scores. So then we looked at commercial credit scores, and we found the same thing. So in looking at commercial scores, we see that these characteristics of utilizing consumer debt also impact commercial credit. And again, thinking in terms of the component pieces, women business owners not having commercial trade files. Again, as we saw earlier, having on average less than one commercial trade. So not having deep credit history or credit trade files, not actively utilizing commercial credit, not having, not managing account balances. All of those characteristics, by not having a commercial trade file or a commercial credit profile, you're inherently suppressing your commercial credit score as well. So if I look at the IntelliScore Plus V2, that's a blended score. So in effect, these characteristics on both the consumer and commercial side are suppressing female business owners' credit score. Overutilization of consumer credit driving my consumer score down, non-utilization of commercial credit driving my commercial score down. You blend those and you can see that in the aggregate, female business owners have a lower commercial credit score than male business owners. And so we asked the question, are women business owners adversely impacting themselves by not utilizing commercial credit? By not going after funds, by not utilizing commercial credit, because of the psychological barrier or lack of mentorship in the market, are female business owners in their pursuit of consumer credit and utilization of consumer credit adversely impacting themselves? And the answer is yes. We see that across the board, these characteristics that have been in place beyond 2016, these trends that continue, are hindering and hampering female business owners from a business funding standpoint, as well as consumer credit standpoint, as well as commercial credit standpoint. Across the board, is adversely impacting female business owners. So in summary, based on this analysis and our findings, what have we seen? So we can say, again, everything that we see and everything that we've looked at in terms of third-party statistics and what we've seen beyond just this analysis is that women-owned businesses are thriving in the current economy. again, opening 1,821 businesses on average a day. We're not looking at these businesses going out of business, so to speak. They are thriving in spite of, characteristics of their utilization and access to credit. Male and female business owners, based on the firmographic analyses we did, there's not a material difference between the two parties. So the businesses in and of themselves are very comparable. The mix, the percentages that operate in each respective SIC, very comparable from a profile standpoint, but the way that they manage credit differs greatly. Again, going back to these psychological barriers or these things beyond, impediments in the market. It's more of a, I don't think I can access credit. I don't know how to go after getting credit. I didn't think I could get funding. There's a lacking of depth in commercial credit for female business owners across the board. There's high utilization of personal credit to fund businesses, and we know that they're not seeking commercial alternatives. So all of this, just these pure characteristics of how male-owned businesses versus female-owned businesses operate, women-owned businesses are adversely impacting themselves by not pursuing otherwise available funds, i.e., commercial lending. And I think from a solution standpoint, obviously there's a need for mentorship and guidance to thrive and survive and continue to grow. And again, this is not something that's occurred today. It's that psychological barrier that's been in effect essentially for the past 3 years plus, and it continues to persist in the market. And so there's obviously a need for some level of guidance or mentorship or direction as it relates to understanding access to commercial credit, understanding access to utilization of commercial credit, as well as understanding the impact that not going after commercial credit is having on both their consumer and commercial credit profiles. So with that concludes the presentation, so we'll move to questions.
Okay, thank you very much, Andrew. Great presentation. Some really excellent information there in that deck. We did have a couple of questions that came in, and folks, if you would like to submit a question, remember just use the Q&A applet in the WebEx panel there, and we'll try and answer that. If we can't get to the question, we'll answer that after the fact. There was a question from Mary, says that she had seen a study recently stating that women in general have higher credit scores than men. Can you explain why the study is suggesting the opposite of that?
Yeah, and that's an interesting observation, because and this had come up as well whenever we were doing the study. I think if you look at Vantage 3.0, so just using our standard, the most recent, or not the most recent, but Vantage 3.0, you do see that in the aggregate, in terms of the general population, females have higher credit scores than males. And so we sort of looked at that as well when we were discussing this. And I think the thing that I would point out, if you're looking at the entire population, females do have higher credit scores than males. But when you start to isolate the subset of business owners, we see a complete shift in that. And so, one, we're looking at a much smaller population relative to the general population. And again, based on how female business owners manage credit, utilize high levels of consumer credit versus commercial credit, that downward pressure, we see a shift in terms of the consumer credit scores for those respective business owners.
Okay, very good, very good. A couple more questions that came in here. Cecilia asks, what's the difference between a FICO score and a Vantage score?
So, and let me make sure I get this right. So Vantage is, I don't want to give, and I apologize. We might have to take that one offline. I can get you the exact definitions, but I don't want to speak incorrectly as it relates to the context or the inputs relative to both of those scores.
Okay, yeah, no problem. Tom asks, why would revenue for women-owned businesses be lower than male-owned?
So I think that goes back to, if you look at the percentage of business owners relative to the industries in which they operate. So for construction for example, and I had looked at this, so I'm pretty confident in these percentages, but in the total population, I think about 10% of male-owned businesses were assigned an SIC of construction or construction-related services. So again, from a construction standpoint, those are, if you're building a house or doing commercial construction or providing services in the construction industry, you're going to have a much higher ticket item than if you're doing, accounting services or healthcare services. So I think it's a variance. I think it's the percentages of men that are aligned with construction, as well as just the average ticket. If you're building a $400,000 house, that's much different than a $100 billable hour for accounting services. And so I think that's going to elevate the revenues for male business owners.
Okay, very good. We've got one here on marketing from Lisa. Do you believe that some of this may be attributed to female-owned businesses not being targeted from a sales and marketing perspective? And I'm assuming from the lenders or financial institutions?
And so that's where it gets tricky. And I'll just give some of my commentary. And one of the things that we were cognizant of during this is I wanted to be cognizant of male versus female and not pit the two together. You would think from a business, again, I use the term, free market. In our economy, you would think that male-owned businesses and female-owned businesses would and should be treated the same. So I can't say with any authority that female-owned businesses are marketed to less than male-owned businesses. I would be surprised, and I think that would be a disservice of financial institutions to either actively target, or maybe not even actively target, but just by some means of segmenting the population, they inherently, to some degree, adversely impact female business owners. So again, that's a very subjective answer, and I can't say with certainty. So I don't know, but I think you can get to a level of sensitivity there when you start talking about is one group being targeted for more or less than the other.
Yeah. Okay. All right. Well, I think we will have to leave it there, folks. That was all of the questions that we had come in. We would like to thank everyone for attending today's webinar. And when you close the webinar out, you'll be taken to a short survey, and we greatly appreciate your feedback. Also look for a follow-up email from us with information about the event, including links to the recording and the presentation slides. And for more information on Experian, go to experian.com/B2B. And thank you, and have a good day, everyone.